So silver is the one that when it breaks out, and I'll say the same thing I said last week. If silver breaks out, if gold breaks out, if Dogecoin breaks out, then Bitcoin will break out. They'll all go together, and I expect that to happen before the end of the summertime. And I think that Bitcoin and the crypto world will have a two-prong situation of negative real yields around the globe, the financial guardrails drawing in investors, especially the growth side, and we'll start to get an upward movement. In a year from now, we'll be talking about doubles in crypto as opposed to doubles in memory.
For months now, crypto investors have been trapped in one of the most frustrating market environments imaginable. Bitcoin has continued grinding through violent volatility. Altcoins have struggled to regain momentum. Every rally has been met with fear, macro uncertainty, and endless debates about inflation, interest rates, geopolitics, and whether the AI boom is about to crack global markets apart. But a big shift may already be underway. According to macro investor and market strategist Jordi Visser, the next phase of this cycle may not just be another crypto rally. It may be the beginning of a full regime shift across global markets, one where commodities, Bitcoin, silver, gold, and digital assets begin massively outperforming traditional stocks. And unlike the short-term noise dominating headlines right now, Jordi is looking much further ahead. He believes we could be entering the exact type of environment that historically fuels explosive crypto expansions, rising inflation, negative real yields, weakening confidence in financial systems, geopolitical instability, and massive structural demand for hard assets and decentralized networks. But what makes this prediction especially important is the timing. Jordi isn't talking about some distant 5-year outlook. He believes the breakout could begin before the end of the summer. And over the next year, he believes crypto could once again enter the kind of doubling phase that defined previous bull markets. In today's video, we're going to break down Jordi Visser's explosive thesis on why Bitcoin and crypto could surge sharply before summertime, why silver may become one of the most important assets of the decade, how artificial intelligence infrastructure is quietly merging with crypto rails, and why the next year could completely reshape the digital asset landscape. And later in the video, we'll also cover some massive new regulatory developments happening in Washington right now, involving the SEC, the Federal Reserve, tokenization, crypto banking access, and major policy shifts that could dramatically impact the future of the industry. If you enjoy deep macro analysis, crypto insights, and breakdowns of where these markets may be headed next, make sure to like this video, subscribe to the channel, and turn on post notifications so you never miss what's coming next. Thanks, and enjoy the video.
Again, people don't have any interest because the narrative on silver is, well, how do I just buy silver? The questions I get for silver are very different than Micron. Commodities trade a lot more, and the thought process is a lot more like Bitcoin, where you have to create a narrative around it. So think about gold last year. I mean, every day we talked about gold going higher. Well, now Bitcoin is with gold and with silver. They're in this consolidation pattern. The regime shift that I see happening, and like I said, historically, when you're above 4% in CPI, it is not good for stocks. So the S&P 500, when the CPI is above 4% over the last, I think I did this back to 1928, so figure approximately 100 year, it has a negative return when the CPI is above 4%. When it's below 4%, it has a return of about 12%. So negative versus 12, well, we're just about to cross above 4%. And at the same time, we have 3-month bills at 370 right now. So CPI is going to be 50 basis points above 3-month bills unless the Fed raises rates. And even if they do raise rates, the question is, how much would they raise? I think we're in a negative yield regime, but with growth. So the difference is if the Fed's not going to raise rates like it did when inflation was high, but at the same point, you have CPI that's higher. I think the real risk, and I wrote a paper about this week, the AI trade is moving so fast and the hoarding that's going on is so big that the issue that comes in is if we have bottlenecks, you're going to see some of these companies not meet their numbers going forward, especially if the input costs are going higher. You'll see margins get compressed. And that's where I think the risk is in stocks. I don't see the same risk in commodities. I think commodities, there's an underlying bid by geopolitical needs on copper, on silver, and I think gold is still fitting in there. And I'll just add one thing since I've talked about silver in this group. Silver is a major part of solar, It's needed in every single part of the AI trade, but there's also a growing trade going. March was the largest import month for China in history on silver. Solid state batteries, which I've said repeatedly to people on the institutional side, that if there's one place that you should be spending a lot of time outside of chemicals to make sure you're up to speed, it is batteries. And the reason is, if we want to solve our energy and power problem in the US, the easiest way to do it is to have massive batteries connected to every part of the grid. Because if we can store the energy, then we can use up more of the excess capacity we have, because we do have a lot of capacity on days where we don't need it. It's only on those days where we have to keep the excess in there. So batteries are really important. And China in particular has made huge advances in solid state batteries. This is critical, but the difference is it uses a tremendous amount of silver relative to lithium batteries. And so if solid state replaces lithium over the course of the next 5 years, the silver needs go up dramatically. And if you do the numbers, we just don't have enough supply. So silver is the one that when it breaks out, and I'll say the same thing I said last week, if silver breaks out, if gold breaks out, if Dogecoin breaks out, then Bitcoin will break out. They'll all go together. And I expect that to happen before the end of the summertime.
Every cycle, people make money in crypto. Every cycle, people lose it to hacks, exchange collapses, and compromised accounts. iTrustCapital's premium custody fixes that. It's a closed-loop system. Crypto goes in, but withdrawals only come out as USD to your verified bank. Nobody can drain your wallet because there's no external wallet to drain. Assets are held one-to-one, off-balance sheet, with full tax reporting. And inside an iTrust IRA, gains can grow tax-deferred or tax-free in a Roth. Real U.S. customer support. $100 bonus when you fund through the link below. Same market, smarter structure. Historically, periods of rising inflation and negative real yields have created major problems for traditional equities while simultaneously benefiting hard assets and alternative stores of value. Jordi points out that when CPI rises above 4%, the S&P 500 has historically struggled badly over long periods of time. Meanwhile, if inflation remains elevated while central banks avoid aggressively hiking rates, investors begin searching for assets that can outperform currency debasement and financial instability. That environment has historically been extremely favorable for Bitcoin. But according to Jordi, the real trigger may arrive once markets begin recognizing that the current AI boom is also creating enormous inflationary pressures underneath the surface. If bottlenecks begin forming, margins compress, and stock valuations start breaking down, capital could begin rotating away from overstretched equities and toward commodities, precious metals, and crypto. And that leads directly into his timeline for why he believes Bitcoin could break out sharply before the end of the summer.
So explain a little bit more as to why before the end of the summertime, why that timeline that you're looking at for crypto.
In all my experience of trading markets, when I say a regime shift, there's two types of regime shifts. One is, let's say, one that lasts for a long period of time, and that would be something like coming out of COVID, where you go into it, it's a deflationary situation, and then you print money, and it takes a while for people to grasp the inflationary situation. I started talking about inflation post-COVID in May of 2020, and that was because of the enormous amount of money printing. In this case, I think we're in a COVID type situation from one level that equates this to a regime shift. If you listen to anyone on the oil markets, and I don't know if you've had people on that have traded oil markets for a long time, the one thing they all say as a group is they had all modeled the Strait of Hormuz. Strait of Hormuz is really important to the global economy. It's kind of like its own central bank. Oil matters to the whole world. There's no way to get off of this. Diesel drives the economy. If all of a sudden we see a downshift in the global economy, which I said is showing up in Japan with inside the construction market, showing up with inside the machinery markets, both in Japan and in Korea. This is happening in both countries while the DRAM stuff is still going up. You've got long-term rates which are going higher. And in particular, in the UK and Japan, I mean, we're talking about 25, 30-year highs that we're making in long-term yields in countries that have a ton of debt. These have all been fears at some point. So I think the regime shift is once the technical market starts to break down, whenever that happens, and it can take weeks. That's why I said by the end of the summertime, I think there's a two-sided thing here. One is I think markets have to have a correction. I don't know to the extent because I don't know what's going to happen to the oil price. If you tell me oil's 200, I'm telling you at this point, the stock market can't deal with it anymore because we'd be up at that point, which would also mean slowing growth because we've been using excess inventories. The second part of the trade, though, is if the Fed doesn't move and all of a sudden there is a stimulus thing, meaning, okay, the government the Strait starts to open up and oil prices come down not from 100, but they come down from 150 or 200. I think that's going to be extremely positive for commodities and extremely positive for Bitcoin. But I don't think you're going to see the stock market immediately go higher because we'll be significantly higher. But in the commodity markets, we will.
What are you maybe looking for where you would start to change your mind on some of this, right? Like it seems like you've got a very well-formed view. Is there anything that you're looking at and saying, hey, if this changes, I will adapt?
So I'm probably less of no, not probably. I'm less of a trader than probably, the people that are sitting at home and on the retail trading side. I'm not as slow as an institution. And more importantly, I can sit in things. I started buying Micron last year at 105. It traded down, I think, to 60 in the first quarter of last year. And I bought more on the way down. And then I bought more on the breakout. I have a higher tolerance for things that I think are going to play out over the course of the next year. The way that I'm viewing my portfolio, I just had a home run with most, especially with Micron, with a lot of the semiconductor names. I also lost money last year in the crypto portion of my portfolio. I have upped my crypto portion because I think a year from now, when we get to May of next year, instead of us talking about the parabolic needs of memory, I think we're going to be talking about the build out of the financial infrastructure. I did a webinar this week with a group from Kraken. I spent a lot of time on my portion about, hey, we're building out the AI infrastructure. Only at the beginning of this year did the agentic world start to happen. That's where the inference side kicked in. The other thing that's critical for inference is Ethereum. It's Circle. It's go through the list of the financial guardrails that you want. This is a critical component, is connecting the agentic world to the crypto side. And so when you look at the charts that Coinbase had in their earnings release, and you see them, they look a lot like the charts that Sundar Pichai showed in token usage. So I think when we get here a year from now, and it might take 3 months, it might take 6 months, but that's not what I'm looking for. I don't think silver can go down very much, and I think it will double over the next year. I don't think Bitcoin can go down very much from here, and if it acts like Micron did last year, and I have to buy more at 50,000 and 40,000, I will, because I believe a year from now, we'll be talking still about the AI trade happening. There might be delays and bottlenecks. I think the inflation side will still be on the higher side and we'll still have rates at the lower end. The disruption will be happening to politics. The disruption will be happening to voters. People are going to be angry. And I think that Bitcoin and the crypto world will have a two-prong situation of negative real yields around the globe, the financial guardrails drawing in investors, especially the growth side, and we'll start to get an upward movement. And a year from now, we'll be talking about doubles in crypto as opposed to doubles in memory.
In other news, lawmakers in Washington continue working behind the scenes on the long-awaited Clarity Act and broader crypto market structure legislation. Although the Senate entered recess without final passage due to competing political priorities, staff members from both the Agriculture and Banking committees are reportedly continuing technical drafting work during the break. At the same time, SEC Commissioner Hester Pierce sparked major debate surrounding tokenization and digital securities. According to reports, the SEC is reconsidering parts of a proposed tokenization exemption framework after concerns emerged over synthetic tokenized products, digital assets that track stock prices without necessarily providing actual ownership rights in the underlying companies. This is an incredibly important development because tokenization is rapidly becoming one of the largest narratives in finance. The idea of placing stocks, bonds, real estate, and financial products onto blockchain rails could eventually reshape entire capital markets. But regulators are clearly still trying to determine how far that system can go and what protections need to exist before full-scale adoption happens. President Donald Trump also recently signed executive orders aimed at helping fintech and crypto companies integrate more directly into the U.S. financial system. One major aspect involves encouraging the Federal Reserve to reconsider whether certain crypto firms could eventually gain access to services traditionally reserved for banks, including master accounts. While the executive order does not force the Fed to approve anything immediately, it dramatically legitimizes the conversation around integrating crypto firms into core financial infrastructure, something the industry has been fighting for over many years. Meanwhile, Federal Reserve Governor Christopher Waller is reportedly advancing a proposal involving so-called skinny master accounts, including higher asset caps and formal review timelines for applicants. Although many crypto firms remain categorized under stricter Tier 3 review standards, the broader direction suggests regulators are slowly beginning to build frameworks for deeper crypto integration into traditional payment systems. And finally, another massive development emerged this week as Kevin Warsh was officially sworn in as the new chair of the Federal Reserve, pledging to lead what he called a more reform-oriented Fed, focused on moving away from rigid traditional models. That alone could become one of the most important macro developments for markets over the next several years. Because if the global economy truly is entering a new inflationary and technologically disruptive era, exactly the type Jordi Visser is describing, then central banks, governments, and financial systems may all be forced to adapt much faster than investors currently expect. The biggest question now is whether this summer becomes the beginning of that breakout Jordi Visser is anticipating, or whether markets need one final shakeout before the next major move higher begins. Either way, the next few months may end up being some of the most important months crypto investors have seen in years. If you enjoyed this video, make sure to like, subscribe, and turn on post notifications so you never miss our latest crypto and macro analysis. Thanks for watching, and we'll see you in the next video.